Tom, you've got the most aggressive forecast out there on the S&P. I want to just ask you this before we get to the merits of the forecast. Do you ever feel like you're out on the limb a little bit when you make those forecasts and you're the most aggressive on the street?
Yeah, all the time. I mean,
Yeah.
It's easier for most people to stick to the middle of the fairway. That's why most forecasts are literally around consensus. But I think this year is an example where the common perception was wrong on many things. You know, the idea of a recession starting and one where earnings would miss. There were a lot of people who said earnings would be like 180 this year, and they're tracking 220. And I think many expected the Fed to come out swinging every time the market rallied. But this year, as you know, the Fed's sort of taken a slightly different approach to easing financial conditions.
There's this talk of a soft landing, which we've all been discussing for so many months now. Is that sort of missing the point in the sense that what we're really looking for is just a warming economy rather than a landing economy?
Yes.
Or am I mixing my metaphors too much?
No, I don't think it's mixing. I think that coming into this year, people had very extreme views because the curve inverted and the Fed did such rapid hikes. And CEOs were cautious and the PMIs collapsed. So there was an expectation that we'd be entering a recession by now. I mean, it was...
Right. It should have happened 2 months ago.
Yes. And I do think it's fair to say there should be an expiration date on that view because we now know that inverted curve could really reflect the fact that the neutral rate is still unknown and inflation's falling, so the curve should be inverted. And in terms of earnings, companies did a lot of cutting last year. So they're actually now beating and estimates are going up. That's kind of the opposite of a recession.
So you think the Fed is going to see what it looks for, what it's looking for in the jobs number this week, and how's that going to guide them through the rest of the year?
Well, I mean, the Fed's got a tough job. And I'd say as long as the headline CPI year over year has been over 4, they've had to talk tough. I think the June CPI is going to be the first time they can point to real progress because if it's 3% or 3.1%, I think the market will finally give them credit that they've actually accomplished quite a lot. And from a number of hikes, I mean, even if there's 2 left in the year, and I saw Steve's thing about November's like iffy, I mean, that's, 50 basis points this year compared to 500 basis points of hikes last year. I mean, it's a much less active pace.
So if viewers are sitting here right now watching you and they're buying this bullish vision that you're selling, how do they trade that? What stocks are you looking at to sort of benefit in the back half of the year?
Well, I think investors need to stick with FANG and tech because those are real, true fundamental surprise stories, and easing financial conditions means they can still do well. But I think cyclicals make a lot of sense because if
Which ones?
Well, it'd be things like industrials or airlines, comm equipment. I think consumer discretionary is showing some signs of life. So I think it's what you would traditionally do if you think the business cycle's bottoming.